You can go ahead and take control there, Michael.
I've got it.
Okay.
For everyone joining us, we will get started in about 2 minutes. All right, everyone, it is top of the hour. We do have a lot of things to cover today. So before I hand it over to the presenters, just a few announcements for you. All of our phone lines have been muted. So if you do have any questions, please feel free to use the Q&A box located on your menu bar. If you need immediate assistance, I will go ahead and answer those questions. Otherwise, all questions relating to the presentation, we will hang on to the end. If we run out of time, we will answer all of your questions offline. All right, just as a reminder, this webinar is not for CPE credit. And we'll now turn it over to Shane and Michael and get started. Go ahead, guys.
All right, thanks, Amy. Good afternoon. On behalf of Eide Bailly, I'd like to welcome you all to today's webinar. My name is Michael Holdren. I'm a senior manager for the firm located in our Des Moines, Iowa office. Presenting with me today is Shane Hussar. Shane is a partner in our Fargo, North Dakota office. Shane and I are part of the Financial Institution Services Group for Eide Bailly, and we dedicate 100% of our time to working with institutions like many of you on the call today. Using that industry experience, as well as my banking background, we hope today's content will provide a meaningful and some actionable insights for the coming days and weeks as we progress into the forgiveness phase of the PPP loan program. So let's go ahead and get started. Take a look at today's agenda. First, we're going to cover some recent updates with focus on lender-specific updates. We're going to take a look back over the last 5 weeks, talk about some of the good, the bad, and the ugly with the PPP loan program. We're going to talk about some of the known and unknown pieces of the forgiveness process. We're going to give some best practices and accounting and talk about some accounting considerations. Then we're going to take some time to talk about the calm before what we're calling the forgiveness storm. We're going to look at what planning opportunities you need to consider as many of the PPP loan funding pipelines begin to slow down. Now is the time to start to plan and prepare for the forgiveness period of the PPP loan program. And finally, we're going to take some time and do a walkthrough and demonstration of the forgiveness model that we've created as a firm. So let's go ahead and get started. First, let's talk about the interim final rule that was issued on loan disbursements on April 28th. There were 3 important pieces to that from a lender-specific standpoint. First, loan disbursements through the PPP loan program must be fully funded with the first disbursement. You cannot have loans that have multiple advances. Second, the interim final rule covered SBA Form 1502 and indicated that that form must be filed within 20 days of a loan approval. That's the form you need to complete to collect your loan processing or origination fees. It's my understanding that loan form is not available yet. So any loans that are closed until that loan form is available, you would need to submit those by May 18th. Lastly, any loans that are canceled before disbursement and canceled or voluntarily terminated and repaid after disbursement don't qualify for the applicable loan processing or origination fee. And that's important from a lender standpoint, because when we talk about some of the most recent FAQs, there's been a lot of questions surrounding borrower certifications and certain borrowers that maybe took advances of PPP loans that weren't in good faith of the certifications that were originally issued. So the Treasury has issued a number of FAQs recently asking borrowers to essentially recertify that the current economic uncertainty makes the loan requests necessary to support the ongoing operations of the applicant. Now, they haven't provided a tremendous amount of clarity on that, but they have added some considerations for those borrowers to take into account. One of those is access to other sources of liquidity. Another is if they have a substantial market value. And finally, if they have access to capital markets. What we do have clarity on now, though, however, is that all loans over $2 million will be subject to a detailed SBA review. We also know that borrowers that believe that they have not upheld in good faith the borrower certification can repay those loans by May 14th. And that's a week extension from the original guidance. Those borrowers were supposed to have those loans repaid today. If they do repay those, there is no penalty for not supporting that borrower certification. Now, while all this kind of relates to borrowers, it's important as lenders to understand the impact that any of these types of loans in your loan portfolio or your funded pool may have, as these borrowers will not generate the applicable origination or processing fee. And any of these borrowers that may not meet those certification standards but don't repay the loan, there could be forgiveness implications down the road if they're in fact reviewed and found to be in violation of the certification. Another recent update that we want to talk about is the Fed Reserve Main Street Lending Program. There's some expanded eligibility with that program. And while it's outside of the PPP loan program, I think it's an important piece that we need to kind of keep our eyes on. A couple of the changes that they made is they lowered the minimum loan size from $1 million down to $500,000. They also increased the allowable leverage for the calculation to available borrowers from a 4 times EBITDA multiple to a 6 times EBITDA multiple. So essentially increasing that maximum loan size for certain eligible borrowers. We think that this is an important piece to the ongoing saga of the shutdown impacts related to COVID-19. The PPP lending program has really been a short-term kind of band-aid to the situation, and in many cases not necessarily provided the operating funds that many businesses, small and medium-sized, need. This could be that second piece that once these PPP funds are depleted, that many lending institutions may want to look at providing to their borrowers to help bridge that, that kind of extended gap related to the long-term shutdown from COVID-19. Additionally, the Fed Reserve's expanded their PPP-LF, or their lending facility. We think this is important news for our lending institutions, as we believe it's gone a long way to help solidify an active secondary market. The expansion includes loans purchased, not just loans originated from PPP lenders. So an institution that purchases PPP loans on the secondary market also has access to the PPP lending facility. And that's important because that's a funding source that's at 35 basis points. And as you can imagine, buying 1% assets and trying to fund with existing sources of funding could be quite difficult. But providing this lending facility to those that purchase the loans, we believe it's expanded that secondary market. Plus, they're able to keep the special leverage treatment for purposes of capital. This could create a potential opportunity for some of you that want to look at this as an investment for your potential bank and or lending institution. So we're kind of all on the same page now with some of the more recent updates. When we look at where we've been and where we're going over the last 5 weeks, there's been some good, there's been some bad, and I think what I describe as there's some ugly as well. Through last Friday, over $500 billion of SBA funds have been distributed, where most of you or all of you have been the intermediaries in that system. So thank you for your participation. Without you, this certainly would not be in the place that we're at. The small businesses that we all depend on and some of our close relatives work for wouldn't have the funds that are needed to help keep them in operation. But with the initial funding of $349 billion, that was exhausted in a mere 14 days. That was done through about 1.7 million loans. What's interesting is that actually represents 14 years worth of SBA loan production, and that was done in just 14 days. The average loan size with that initial funding was $206,000. But when we move into that second wave of funding, through May 1st, we've distributed $176 billion, and that's been over 2.2 million loans. And you can see the increase in the number of loans has brought that average loan size down quite substantially. So that's a good indication that there's a number of smaller businesses that are participating in this second round of funding, which is instrumental in keeping a lot of those small businesses open and operating. So as I was preparing for today's presentation, I came across this interesting map, the one on the right. It's a map of the United States showing the percentage of small businesses that have received loans in each state. The darker shaded have a higher percentage of the small businesses that have received loans. So I kind of thought to myself, well, what does that say about some of the community banks and the number of banks in those states? So I found a similar map that shows the number of community banks by state. And not surprisingly, those states that have a higher number of community financial institutions also have gotten more SBA funds, more small business loans to their respective states and local economies. So we believe that the community banks really have pushed this forward. So great job on that. I think that's why many are bullish on the community banking industry over the long term. And this really provides the proof that small banks do lend to their local states and lead the way in small business lending. Excuse me there. So we talked about all this money that's been distributed over the last five weeks, over $500 billion. And that's been great, obviously, in helping support those small businesses. But from a lending standpoint, we've also been able to generate a significant amount of non-interest income. That's obviously good because it helps offset the margin compression that many of us are seeing and will continue to see with low interest rates and a flat yield curve. The loans are 100% SBA guaranteed, so we get the 0% risk-based capital treatment. As I mentioned, the PPPLF through the Fed Reserve offers a low cost of funds, also offers that neutralized leverage ratio impact for loans funded. I think one really important piece to consider in this whole thing from a lending perspective is these loans are forgivable, and many of them have gone to your existing customers that have borrowings in your loan portfolio. So these loans have really served as a credit quality protection tool by providing a stopgap funding mechanism for some of our businesses and borrowers. So in the long run, maybe there's been some pain and some angst with participating in this program, but it does serve the lending institution beyond just the fee income that's being generated. Additionally, many of you have had an opportunity to meet new customers, help them in what is a critical time in business survival. You've also been able to lend to some of your traditional non-borrowing customers. Don't lose sight of those opportunities. This is a time where you're providing critical funding to their business needs. Grow and nurture those relationships. Hopefully they turn into long-lasting, long-term customers. And finally, many of us have really been thrust into this kind of unknown loan pool and program, and it's been we've been having to do this in what is kind of a fragmented environment. We've got remote workers, we've got branches that are closed, we've been asked to process all these loans. And at the end of the day, while it's probably been difficult and painful to say the least, I think in 6 months or a year when we look back at this, there's many positives that we'll be able to take and look forward and implement into our future processes that we've learned. But not everything's been good, right? There's been plenty of bad too. There's a significant amount of uncertainty still outstanding and throughout the process. There's been numerous rule changes, updates, clarifications along the way. Many of you had issues getting signed up and approved to be an SBA lender. And once you got approved, you couldn't get anything through the system. E-Trans had significant bandwidth issues. Many of you, God bless you, have spent overnight working to get these applications processed for these businesses, gone the extra mile. It's awesome for each of you to do that for your customers. There's also been some capacity issues, staffing, as I mentioned, remote working. Initially, there were some liquidity and capital issues or capacity issues was kind of solved with the PPPLF. We've had closed branches. We've had difficulties collecting information, closing documents, getting signatures. There has been some difficulties, obviously, with this process. And finally, most of the rules have required prospective treatment. So along the way, all of your employees and lenders have had to get up to speed each time with the new rule. And we believe it's probably increased not only the difficulty, but potentially some of the issues in the forgiveness and loan eligibility along the way. So finally, let's talk about a little bit of what I'll call the ugly. According to the U.S. Chamber of Commerce, there's 30.2 million small businesses in the United States. Through May 1st, only 3.9 million have received PPP loans. That represents 13% of the total small businesses. So my question is, what happens to the other 87%? You know, why haven't they participated? Do they not have access to a lender, or do they not think they need the funds? I think we all know that the 13% potentially have long-term funding concerns. So those 87% that haven't participated, what is the long-term viability of those small businesses? Recently, there's been a fair amount of negative publicity in the media. You know, obviously the large and public companies that were granted significant PPP funds that probably in some eyes didn't need the funds. Some large banks have treated their customers with preferential treatment in certain business segments. And even more recently, there's been some articles discussing banks' ability to generate significant fees with no perceived risk. Now, while we all know that there is risk involved in participating in this program, maybe the general public doesn't understand that. In order to mitigate some of that risk, the reputation risk, there are some banks that have actually considered donating a portion or all of the fees associated with the PPP loan program. There's obviously many forgiveness questions that remain unanswered. We'll discuss those in more detail in a little bit. But those borrowers that were into this program in day one, that forgiveness window is closing by the day. And as I mentioned earlier, the funding has done, you know, not really all that much in terms of helping the overall business operating needs of our small businesses. Employees have been able to continue to get paid. Some portion of operating expenses have been helped with the PPP funds, but the long-term operating needs and the lost revenue isn't addressed with the PPP loan program. So now I'm going to hand it over to Shane, and he's going to talk about, as we shift into the forgiveness phase, what are some of the things that we definitely do know about loan forgiveness?
Yeah, thank you, Michael. And yeah, it's an interesting time because many of you are continuing to process applications here for your borrowers. But as Michael mentioned, that loan forgiveness or covered period, the 8-week period, is slowly or quickly coming to a close here. And so now we're shifting our focus onto the next step, this second phase of loan forgiveness. And here's what we know based on what's in the CARES Act and what's come out in subsequent interim final rulings. And we're starting to form a picture of what that loan forgiveness looks like. So first off, we know and understand that payroll has been pretty well defined for purposes of loan forgiveness. And we interpret our payroll to be our gross wages to employees up to $100,000 maximum, and that's on an annualized basis over the 8-week period. So what that means is that for any one individual within a borrower's organization, the maximum amount of salary or compensation that can be utilized for loan forgiveness is maxed out at $15,385. And so any additional payroll costs for those individuals making more is negated from the calculation. What we're driving our gross wage number is based off of, W-2, W-3 type of information. So, when you look at the payroll reports that are being produced by your borrowers, it's that gross wage amount, not a net wage definition. In addition to that gross wage number, we also get to include our employer share of certain benefits, which include health insurance, and that includes not only health, but dental and vision, our employer share of retirement contributions to things like 401k plans, as well as state and local unemployment taxes. So the employer share of those, call them non-cash benefits to employees, are includable as payroll costs. One thing to remember, this isn't the only program that's out there. There are other credits that are available to organizations, and the Family First Act, which is really the first tranche of our of our relief that came out of Washington in response to this pandemic, allowed for certain credits to allow for individuals that had qualified sick leave supplement some of those payroll costs. And so if the customer is taking advantage of those refundable credits to pay for those employees that are on leave, we don't also get to double dip and utilize those credits or those amounts for purposes of loan forgiveness. Another one of our knowns relates to how we're to treat self-employed or sole proprietors for purposes of forgiveness. And there's an interim final rule that came out about mid-April, ironically after the window opened for self-employed or self-proprietor applicants, that explain that for terms of determining the forgivable amounts for self-employed individuals, we're still going to revert back to our 2019 earnings to come up with that calculation. Because as we all know, over the course of a year, a self-employed individual doesn't, write themselves a paycheck. So to kind of expedite or simplify the process, they've clearly defined what that compensation looks like for a sole proprietor or self-employed individual, which is equal to 8 weeks of their 2019 compensation. So you're pulling that number from your Schedule C or Schedule F return if you're working with a farmer, and that's going to be the allowable amount for a self-employed individual. Now, if they have payroll costs for other employees, we're going to continue to follow our payroll definitions, which are outlined above. So as we look at what non-payroll related costs are forgivable, they're defined in a couple of different places and limited to our mortgage interest on any existing debt prior to February 15th of this year. We can also request forgiveness to non-payroll costs related to utilities, and these are kind of your standard utility items, so electricity, gas, cable, internet, trash, phone. Interestingly, transportation's also included in there, and actually it's in the self-employed interim final rule that it specifically describes gas for vehicles as being a forgivable cost. So you expand that out a little bit further and you think about some of our borrowers that maybe have some sort of fleet, there could be a significant cost associated with fueling those vehicles, and so those costs are included. Finally, our last non-payroll related costs that's inclusive is for rents, and again, those agreements have to be in place or existing prior to February 15th. So that's kind of how we're going to determine our maximum forgivable amount. Now, there are a couple of reductions that come right out of the CARES Act that essentially penalize the borrower for not using the funds as intended. Again, this is the Paycheck Protection Program, so the focus is, of course, on payroll. So if borrowers had reduced their staff or their employees during a period of February 15th through 30 days after the enaction of the CARES Act, which is April 27th, there will be a percentage reduction, essentially a pro rata reduction in the forgivable amount equal to the decline in your full-time equivalents during our 8-week period, compared to a couple of comparative periods, which we'll outline a little bit further as we go through our demonstration. Our second reduction to our forgivable amount relates to a reduction in compensation. So as a kind of a risk mitigation standpoint, there's several businesses that did across the board compensation cuts, or maybe some of those cuts were a little bit more specific. There's a penalty in there, a dollar for dollar reduction to our forgiveness for any compensation amounts that or reductions that were greater than 25% of that employee's previous compensation or salary. And this is going to be something that'll need to be tracked on an employee by employee basis, which could prove to be a little bit of a challenge for our customers or our borrowers. And finally, we'll talk a little bit further on how we're determining our pay periods or our periods, comparing our covered period versus some historical periods. Those are defined as well in the Act, and when we get into our demonstration on the model, I'll talk about those a little bit further.
All right, thanks, Shane. Well, there are some things we clearly still don't know. One of those is how the forgivable expenses will be treated during the 8-week forgivable window. Is it based on payments made, or essentially a cash basis, or is it an accrual basis, the costs that are incurred? How is forgiveness impacted if a business doesn't meet the 75% threshold for payroll costs? Right now, we're taking the approach that it's a pro rata reduction, but that has not yet been defined. How about the treatment of full-time equivalent employees? Right now, we're relying on prior SBA guidance, which uses a 30-hour work week. But again, that has not yet been defined. Can the 8-week window for forgivable expenses extend beyond June 30th? Right now, the statute explains the covered period ending June 30th, but any loans funded subsequent to May 5th have an 8-week window that extends beyond June 30th. Is interest on non-mortgage related debt forgivable? How about related party rents? Are they forgivable? And finally, what happens to a loan if a business is found to have violated the certifications? Is it required to be immediately repaid? Are there penalties? All of these remain unanswered at this point, and as many of you sit, so do we, waiting for final guidance from the Treasury and SBA. But despite what we don't know about the forgiveness program, that doesn't mean there aren't some best practice considerations that we can implement as we move forward. For those of you that created separate deposit accounts for your PPP funds, we believe that that is a best practice and you will be served well for doing so. It gives you the ability to track the liquidity as well as the borrower spending as those funds are expended on forgivable items. It essentially gives you a bird's eye view of both the asset and the liability side of the balance sheet. We also think you should strongly consider collecting data from your borrowers during the 8-week period relating to their forgivable expenses. Not only will this create a more efficient process and effective process during the forgivable period, but it also helps put you in the driver's seat as you start to look at getting these loans forgiven from your books. And finally, Using the PPP lending facility, again, this provides an overall low cost of funds. You get the leverage neutralization. They're perfectly match funded. And probably most important, it helps you preserve your on-balance sheet liquidity. There are many unfunded commitments out there that may be drawn upon as long-term needs for funding continue. Having that balance sheet liquidity is important to help meet those unfunded commitments, as well as any strategic opportunities that come up along the way. Now, there's one thing to take away from this presentation. I guess maybe it's taking a look at this graph. What this graph illustrates is the return profile by loan size of PPP loans. Essentially, what it's telling you is over a 24-month period, which is the loan period or the note period for these PPP loans, what is the return profile? And you can see the return profile is significantly favorable for loans that are forgiven or repaid early, as well as the smaller 5% fee generating loans. So finally, prepayment is your advantage. So don't wait to get these loans taken off your books. Again, that's why we believe collecting that data, trying to help understand the forgiveness piece as you move into and toward that 8-week closing window is critically important to helping capitalize and maximize the return for participating in this program. So how can you control that? Well, one way you can control that is applying for early forgiveness through the SBA. The statute allows lending institutions to apply for expected forgiveness after 7 weeks. To do that, you have to file a report with the SBA. It includes 2 of the forms you needed when the application of the loan was funded. You also have to create a detailed narrative explaining the assumptions that you use to develop your expected forgiveness, any alternative assumptions and why they weren't used. And then here we go again, supporting it with any borrower documentation that you've collected during that 8-week period. Again, collecting that information helps you project out any expected forgiveness during that period. So once you get all that information pulled together, you complete this report and you submit it to the SBA, and they will purchase the funds back once they determine that report to be reasonable within 15 days. And that's important when you look at the traditional, or what will be the normal forgivable application process. The details of that are the borrower submits their application, the lender has 60 days to approve, and then the SBA has 90 days after that to approve. So it significantly extends that forgiveness period and the potential forgiveness timeline. So again, if it's important, which we believe it is, to help try and control that return on this program, being in control of that forgiveness, whether it's through the early forgiveness phase or collecting that data up front, will be critical to helping maximize that return. So now I'm going to hand it back to Shane again. He's going to talk through some accounting considerations that you want to take in and keep in mind as you're booking these loans through this process.
Yeah, thanks again, Michael. And here I thought the accounting considerations part was going to be the most exciting part of this presentation, not your graph, but I guess I'm wrong. But you know, we're remiss to not address the accounting for how to handle these origination fees, and really kind of a bunch of the different elements on related to the PPP program. So, you know, lenders, you can kind of tune out for a second. CFOs, make sure you're paying close attention. So what do we do with the origination fees, those processing fees for, you know, that we're set to receive from the SBA? So at funding, we've essentially done the work that's required of us as lenders to record and earn those origination fees. And so absent of actually collecting those fees from the SBA, which we continue to wait for those payments to come in, we would book a receivable from the SBA for those processing fees. And our offset to that, generally speaking under GAAP, would be to credit a deferred loan fee. So similar to our other origination fees under ASC 310-20, which is the accounting standard related to loan fees, we would defer those fees and accrete those fees over the life of the loan, similar to what we would do with other origination fees. Now, We understand there's kind of diversity in practice from how financial institutions have traditionally treated origination fees. You know, depending on your size of institution, it may or may not be material that those deferred fees or costs. And so we believe there is a practical expedient to recognize on a cash basis those deferred fees right away into income rather than deferring them if we've determined that they are in fact immaterial to the financial statements. Now, for those clients that are subject to an audit, you know, another consideration in determining whether or not we can just book all of that origination fee income upfront is our determination of whether or not those loans, or the majority of our PPP loans, will be forgiven prior to June 30th, which is our next call report date. So if we've determined that all of our fee revenue is going to essentially be recognized in one financial reporting period, we can take a practical expedient, and rather than trying to come up with a deferral calculation, we would just recognize that all on a cash basis. To be honest, I anticipate that a large number of institutions will be able to utilize one of these practical expedients, but if you do have questions on this, absolutely reach out to one of your Eide Bailly professionals. So as we look at interest income as being the next item, you know, again, this is something that you know, maybe there were a little bit of questions in terms of when we can kind of turn on the spigot of generating interest income. And in the interim final rulings that came out after the CARES Act was released, it did clearly state that interest begins at origination or when those loans are funded and accrues regardless of that 6-month payment deferral. And in fact, accrues all the way through the forgiveness application period, right? So as Michael mentioned, you know, we're going to obtain, you know, maybe start that forgiveness process and start building that application and submit it to the SBA. And we're going to accrue interest essentially up until the point where we get notification of approval from SBA. So at that point, we know that that amount is forgiven, and we can turn around and recognize, you know, the receipt or set up a receivable, I should say, from the SBA for the forgivable portion. And again, that's going to be both the principal loan amount that's going to be forgiven, as well as any accrued interest that's going to be forgiven up until that point in time. From a grant date or a forgiveness grant date, if we had deferred any loan fees, those amounts would be accelerated into income on a pro rata basis up until that point, based on the amount that's forgiven and the amount of residual loan that's outstanding after the fact. And of course, you know, just a reminder, once that forgiveness application's been approved, we're letting our borrowers know that a portion of their loan, or perhaps all of their loan, has been forgiven. A couple other considerations quickly on the accounting. Depending on what the financial institution's strategy for the loan portfolio is, will determine our classification for financial reporting purposes. So if the intention is to sell these loans, regardless of whether we anticipate selling it now prior to the you know, forgiveness application, or we look to pool and sell off any residual balances on those loans, at any point in time when the financial institution determines that we're going to turn around and sell these loans on a secondary market, we would reclassify the loans from held to investment into loans held for sale. Lastly, from a default perspective, hopefully we don't have too many of these instances, but reality is that these are trying times, and there is inevitably going to be some defaults from borrowers. And obviously, your responsibility as a lender is to monitor the performance throughout the life of the loan. And once you do seek to collect on those SBA guarantees, you would de-recognize that loan and any interest related to it and record the receivable from the SBA for that guaranteed loan amount.
All right, thanks, Shane. And all the lenders can wake back up now. So here we sit. As I mentioned, many of you probably are seeing fewer applications at this point, maybe wanting to kind of take a breather, maybe take vacation after what's been a pretty trying application and funding period. But let me caution you against that. This is the exact time when you need to start planning and preparing for what will be this forgiveness onslaught of applications. We think there's really three critical areas in which you need to plan and prepare. The first of those is developing a communication strategy. We'd recommend providing a checklist of data needed to the borrowers as soon as possible. You'll see a checklist as part of our model that Shane will cover. Start developing weekly emails to your PPP borrowers to create a consistent message. Update your website, develop a social media strategy. Well, idea here is to create a consistent message and delivery mechanism for however your borrowers digest their information, but to keep them as informed as possible. Consider developing an alert system, maybe a text system for any new guidance or updated information on the forgiveness process. And then really think back on any maybe issues you had during the information collection and sharing period. Do you have a portal, a secure email? What issues did you encounter during the application phase? Try and rectify any of those situations or any of those issues so that the forgiveness phase goes smoother. Second, take a look at all the loans you've closed and review the documentation. Obviously, this funding phase has been fast and furious. So take a look, gather and finalize any open documentation on funded loans. Make sure your files are buttoned down. If they do get reviewed or if they are subject to any audit, you want to make sure now is the time that you clear any informational gaps or issues while it's still relevant and close in memory. Think about creating a pending pipeline for forgiveness applications. Kind of reverse engineer that funding application pipeline to create that forgiveness pipeline, to create an idea of any areas of concern. Think about developing a bucketing approach. Consider all of the different applications and borrowers that are in your PPP loan portfolio. Certain customers will not be the same as others, just from the standpoint of the amount of resources and time their application and forgiveness process might take. An idea might be, for instance, anybody over a $2 million loan, we know that they're subject to a review. That could be a bucket. A more complex business or a business with a higher number of employees could be another bucket. The idea here is to make sure that certain loans that are in the application or the forgiveness application process aren't the cog in the system, slowing down maybe what would be a normal expedited forgiveness of other borrowers. The idea, again, is to try and create an efficient process, make sure that your customer service is top-notch through this forgiveness piece. Finally, just as Shane had mentioned, kind of keep an idea of where there may be any going concern issues for some of the businesses, maybe the restaurant, the oil and gas industry. Just keep a close eye on those borrowing relationships. We know that probably some of these borrowers won't make it through this 8-week period, so just keep a close eye on those. Finally, establish forgiveness processes and procedures. You need to really understand the forgiveness guidance as it sits today, and then make adjustments to any clarifying or final guidance as it's released. Design a workflow, kind of integrating the checklist that you've developed or used, the data you're collecting, and any model that you might be using. Train your staff on the forgiveness process and those procedures. Use the model to help train them on those processes and procedures. Again, collect that data during the 8-week forgiveness period to help understand and project the forgiveness level. That will be crucial if you decide to take the advanced forgiveness approach. But again, use that information to help develop baseline forgiveness process and procedures. And again, just stay on top of this whole process. And the main point of this whole preparing and planning stage is to try and get past any of the issues that you had during that application period and create the most effective and efficient forgiveness period as we move forward. So with that, I am going to hand it back over to Shane, and Shane is going to do a walkthrough and demonstration of our forgiveness model.
All right, thanks. I'm going to try and navigate Zoom as best as I can and move over to our model here. And Michael, if you can just give me a nod if you can now see our forgiveness tool. We're
Yep.
good. All right, awesome. All right, so with about the last 15, 18 minutes here that we have to talk to you here today, we're going to run through the forgiveness model. So again, this is us sort of digesting all of the information that comes out in statute and start to pull it together in a financial form or a template. And so the idea behind this model is that we'll be able to utilize it to determine what our forgiveness amount is, and potentially start to use it as a tool to pull that information together now with our borrowers versus waiting to the forgiveness application point, 5, 6, 7, 8 weeks from now, depending on when that loan was funded. So with this Excel spreadsheet that we've put together, there's a bunch of different elements to it. It appears pretty complex and seems pretty daunting from the perspective of having a lender potentially work through it with a borrower. But we've really tried to simplify it down as best as we could based on the dynamics of the act and the different provisions that are in it. And tried to make this as user-friendly as possible so that we could use it to help our lenders support their borrowers. And so I'm going to start with kind of the end in mind. This tab that I'm looking at right now is our loan forgiveness tab, our tab C, if you can see the bottom of the screen. And this is essentially the kind of the end picture. This is what it looks like after all inputs are included in the calculation, which we'll talk about a little bit here after I run through kind of this final summary. But this is kind of our goal. This is our what we're trying to get to determine that loan forgiveness amount. So our starting point obviously is what our original max loan amount is. So we pull in that information that we originally pulled together in through our application period. So a lot of this should look fairly familiar in terms of looking at that max loan calculation amount. They should have been utilizing, the prior year, payroll costs and determining what that average monthly amount is, and then we take it by 2.5 times to come up with our loan amount, obviously to the maximum of $10 million. And so we've built into our tool actually a way to kind of go back and back check. So as Michael mentioned, we've got a place where we can pull back some of that historical data and ensure that, during our rush that we, if we maybe interpreted the guidance incorrectly as we're processing some of these applications, we can kind of go back and do a back check at some point and determine whether there's, maybe an error in that loan amount or in that calculation. So for now, we're interpreting that we calculated it correctly. So for the purposes of this example, which I pre-populated out of the interest of time, our loan amount is roughly 1.1 million. So kind of what I mentioned earlier when we were going through the slide deck is starting to incorporate some of our knowns into determining what our loan forgiveness amount. And our first step in that process is to start to pull together our payroll costs over that 8-week period, which I kind of detailed out a little bit earlier, and we'll go into detail how we break that out. But we're incorporating those applicable payroll costs, whether it's via self-employed individuals or it's your traditional large business organization, and then also incorporating in our rents, utilities, and interest on covered mortgages. And for purposes of the calculation, we've got it all sort of linked, so it pulls in from kind of the supporting information inputs tabs. And so again, I'll go through that in a little bit greater detail. So at the end of the day, what we're looking to try and determine is what our maximum loan amount or loan forgiveness amount would be based on our forgivable payroll costs and non-payroll costs. Then we have to talk about our required reductions for loan forgiveness, which is our third step. As I mentioned, there's two distinct reductions in loan forgiveness, and really it comes down to an employer's ability to maintain payroll through our covered period. The first one is our review of the number of full-time equivalents during our covered period, which is our measure that we're indicating here. And we are comparing it against the lesser of monthly average FTEs for the following two periods, which is February 15th to June 30th of 2019, or the lesser of January 1 through February 29th of 2020. And so the way that our interpretation of the standard reads is that this would be a percentage reduction in our forgivable amount based on the reduction in full-time equivalent employees during our covered period. Now, there is a ability to remedy that, which you have until June 30th to bring yourself back up to full-time employment. And I'll talk about that a little bit further as we get into that information input tab and how that all funnels into the calculation. But that's our first potential reduction in our loan forgiveness. Our second one is related to our compensation reduction. And again, we talked about that a little bit earlier, where it is a reduction dollar for dollar for any employees that received a reduction greater than 25% of their payroll prior to this covered period. And so again, I'll jump into how that looks like for purposes of the calculation. Finally, the last step in determining our estimated loan forgiveness relates to the 75% rule, which is hotly debated. And as we mentioned, as we review all the different updates to the FAQs and those interim final rules, it leads us to believe that there will be a pro rata reduction for any payroll costs that we fall short of that 75% threshold, which is what we're demonstrating in our calculation here in step 4. So we literally just missed that threshold by mere percentage points in determining that we used that our payroll costs used for forgiveness made up 74.8% of our total forgivable amount. So we're going to have to take a reduction to limit essentially our non-payroll costs to that 25%. And so that's our third potential reduction. Now, again, this is an assumption, that specifically is an assumption, so I highlighted in blue just for purposes of this demonstration. But again, there's some merit for it based on, kind of the existing guidance that's come out that leads us to believe that that's how it's going to be treated. So at the end of the day, when we looked at our maximum forgivable amount and we take into consideration our potential reductions, we come up with our estimated loan forgiveness amount, or our non-forgivable portion, which we believe would be then termed out over the remaining life of the loan. And what we did for purposes of our calculation is broke out, what amounts were attributed to us failing to utilize all of our loan proceeds during our covered period, and what amounts, which is 1.1 million, we only used 962,000, so a portion of that is just the fact that we didn't spend all of our loan proceeds, and then what amount is attributable to those limitations that I discussed above. So keep this end in mind. It seems pretty simple on the surface, and to be honest, I think there's going to be a large swath of our borrowers where it will be somewhat simplified from that perspective. But there will be other borrowers that will definitely require a more intensive view, and that's where we start to get into putting together our inputs. And so in our calculation, this information input tab is really where we accumulate some of that data. So keeping kind of a consistent approach, we'll start with our historical payroll inputs, and we break it out by month. But this is information that you've probably already accumulated over the course of the loan application process. And so a lot of this is going to be kind of a second check or verification that the information that was provided on the front end is consistent with the way that the standards are interpreted, and so it's kind of a back check calculation. However, from a historical perspective, we also need to start accumulating data for our potential FTE reductions, and so we have a spot where we can accumulate that information and determine our calculation. As we mentioned, we believe it's going to be based off of the SBA's existing determination of the definition of a full-time equivalent employee. And so we've included a couple of different comment boxes that describe how we're interpreting that calculation. We've also provided a couple of other comment boxes throughout which help to define different definitions throughout. Again, can be utilized as a tool for either the lender or the borrower to help fill in some of this information. So when we get to the next step where we're starting to input our estimated costs, we set this up initially to be linked to what we're going to call a request list or input sheets from the customers initially, but this can be updated over the course of our covered period, to the point where if we've done a good job communicating with our customer and we get into weeks 6 through 7 of that covered period, we've got a substantial amount of that information populated. And then if we decide that we're going to apply for advance forgiveness, we maybe have a reasonable estimate for week 8 in determining, okay, this is the amount we believe will be forgivable, and we can feel confident that our assumptions are correct and legitimate, and we can apply for that forgiveness. So we have multiple areas where we can, add different locations for rents, for all of our varieties of utilities, things of that nature. Again, we're pulling in our average FTEs for our covered period for purposes of that reduction calculation. All that information can be populated and built out over that 8-week period with your borrower. We have some additional inputs that are on this information input tab, which again are critical for determining those potential reductions in related to either our number of FTEs or in our compensation. And so, we cover some of the additional information related to, those comparable periods. So we're obtaining FTE information based on both part-time and full-time FTEs to come up with an average FTE during our comparable period, which is a similar calculation to above of how we're calculating it during our covered 8-week period. So as I mentioned earlier, there is a relief from any reductions in workforce, that if we hire back full-time equivalent employees, we can take credit for that and not be penalized for a reduction in workforce. So for purposes of our model, we demonstrate that we had an average FTE over the period, of roughly anywhere from 78 to 81 employees, or a kind of an overall average of 79 employees. We compare that to our historical period, which was 87 employees. We can factor in any additional hires prior to June 30th to come up with a total of 82 FTEs, which is being incorporated into our calculation here on the summary page. So hopefully I haven't lost you guys on that, but we've kind of incorporated all of that into our model. Finally, our last piece on this information input tab relates to that compensation amount. And so as we mentioned, you get penalized or a borrower gets penalized from a forgiveness perspective if they reduced any employee's salaries above 25%. And that's limited to employees making less than 100,000. So for your executive management, I mean, by all means, cut them down to 100,000. Don't actually do that, but just something to consider, that you don't get, that those employees that are making over 100,000 are, excluded for purposes of determining this calculation. So our covered period for purposes of this calculation is the previous quarter prior to the start of this whole, this whole deal. And so it's January 1st through March 31. And interestingly enough, the way that the CARES Act reads, it says you got to compare the 8-week period compared to the previous quarter, which is not an apples to apples comparison. So one of our assumptions is that we believe it'll be on an average weekly basis, not comparing a quarter to an 8-week period. All right, so that's kind of the crux of the calculation. Now, we did develop some kind of input sheets, which are really meant to be our starting points to work with our customers. So a lot of this information, as I slowly kind of scroll through it, I'm not going to spend a lot of time out of interested time on it. But this is the information that we think our lenders could definitely provide to our borrowers on the front end to start building out some estimates. And so this input sheet here that I'm scrolling through is tied into our, what we're calling a data request list. And again, this is something that can be used with our borrowers in mind so that they can start pulling that information together. Again, we've kind of accumulated all of these different components into into kind of one spot that they can start pulling in their payroll information, and all of those non-payroll related costs. And so we've got all that information laid out in a request list. And then we've also added some notes that are kind of starred or indexed that provide some further information for consideration throughout this process. Lastly, our last tab is just an instruction tab. So whether it's the lender or the borrower kind of working through this calculation, we've built it out to kind of clarify what we're looking for, and also highlighted if there's any assumptions that are being incorporated as of now into the calculation. We've listed them out. And again, one of the big ones we're assuming is that our covered period is going to be based on an accrual method, not a cash basis for determining those costs.
Hey Shane, can you go to the last calculation quick?
Yep, on which?
I just wanted to throw out, putting my former banking hat on, I guess. Am
I in the right spot?
Just the final forgiveness calc.
Okay, yep.
You're being asked to review. Obviously, there is a hold harmless on that kind of process of approving these. But what type of review as a lender are you going to have that shows that you looked at this? I think a page like this, where the data has been inputted into a model that can be put in a file alongside a borrower's calculation if they've provided one, is a good piece of insurance, so to speak, that you've done your review, that the file's closed, what you submitted for the application to the SBA. You've gone through your due diligence enough to double check that calculation. So I guess just thinking through that, think about what kind of information you're going to have to provide or keep in a file to prove, in case these loans are subject to review by the SBA, that shows that you did at least enough cursory overview of that borrower calculation for the purposes of forgiveness.
All right, so we're running a little bit short on time. Well, actually long on time, and I apologize for keeping everyone here a couple of minutes late. And I also apologize, we won't be able to answer the questions that are coming through on the Q&A. But we will get a accumulation of those questions, and we will respond to you directly. We'll disseminate them out to your Eide Bailly relationship individual, and they can answer them to you directly. But I do want to point out we are releasing this model to our lenders, or making it available to our lenders. And if you are interested in that, you can go to eidebailly.com/PPP lender, and that is where you can go to put in your information if you are interested in obtaining a copy, if you feel that it is useful for your organization to be able to utilize. Now, there will be a cost associated with that. We've put in a considerable amount of time into digesting and understanding the the complexities of the calculation. And one of the things that we think there's some benefit for, once we release the model, is that we will continue to update that model as the more information does come to light, that we're pushing that information out to any of those individuals that or organizations that have purchased the model from us. And so the idea there is that we are anyways digesting all this information at a pretty rapid pace, that we'll push that out to you as the lender through an updated model as that information comes to light. So again, we think this could be a useful tool for you as a lender. If you're interested in that, again, go to PPP lender landing page on our eidebailly.com website. If you're just very quickly, if you're interested in passing information on to your borrowers, there is another webinar that is scheduled for next Wednesday, specific to the PPP lending program, that is available on our Eide Bailly website as well. So with that, thank you very much for all that you're doing for our to help support our economy, to keep our small businesses intact. The efforts that you guys are putting forth. Again, we're here to support you guys and see success in the long run. And thank you again for everything you're doing. And thanks again for joining us today. Thanks a lot.
All right, thank you everyone for attending. Thank you to our presenters. And as a reminder, we will email out the recording and the presentation. Just give us a few days to get everything edited. So look for that in your email. Everyone have a great day.